Hello everyone, this is Sherzodbek from CAU Business School. As usual, in our weekly reviews, we're going to review the very first week of 2025 and the coming week from 10th of January till 17th of January. So let's start. The first full trading week of 2025 brought a blend of robust indicators and cautionary signs, offering the glimpse into the US economic landscape. From labor market updates to inflation trends and Fed Reserve insights, the data underscores both resilience and challenges as the nation charts its economic path forward. Talking about the economic indicators, the week began with the release of the S&P 500 Global Services PMI for December, which came in at 56.8, slightly below the forecast of 58.5. While the reading still signals expansion, the lower than expected figure may reflect softening demand in the US services sector. This is a trend worth monitoring as the services sector forms a significant part of the US economy. On Tuesday, the ISM non-manufacturing PMI added further insight, coming in at 54.1, beating forecasts and showing a rebound from November's 52.1. Similarly, ISM non-manufacturing prices surged to 64.4, signaling rising input costs and potential inflationary pressures within the sector. These mixed signals highlight a resilient yet cautious services sector as businesses navigate inflation and consumer behavior. Talking about the inflation and bond market dynamics, Eurozone inflation data as measured by the CPI year over year came in as expected at 2.4%. This stability aligns with the European Central Bank's goals, though policymakers remain watchful of any signs of inflationary acceleration. In the US, bond markets reflected shifting investor sentiment. The 10-year note auction saw yields slightly ease to 4.68%, while the 30-year bond auction later in the week showed yields rising to 4.913%. These movements suggest a balancing act between demand for long-term security and expectations of future economic conditions, including inflation and interest rates. The US labor market continued to show signs of strength, albeit with some soft spots. Tuesday's job openings data revealed an unexpected rise to 8.098 million, surpassing forecasts and signaling strong demand for workers. However, the ADP non-farm employment change on Wednesday showed private sector payrolls increasing by just 122,000 jobs in December, falling short of expectations. This divergence underscores the complexity of the labor market, with high job openings but slower hiring growth in some sectors. Initial jobless claims for the week dropped to 201,000, lower than the forecast of 214,000. This unexpected decline suggests fewer layoffs and still tight labor markets. On Friday, the non-farm payrolls report surprised markets with a robust gain of 256,000 jobs in December, well above the forecast of 164,000. The unemployment rate ticked down to 4.1%, underscoring the continued strength of US employment. Average hourly earnings grew by 0.3% month-over-month, in line with expectations but slightly below the previous month's 0.4%, indicating moderate wage growth. In the energy sector, the crude oil inventories showed a draw of 0.959 million barrels, less than the forecast decline of 1.8 million. This smaller draw could reflect weakening demand or high production levels, factors that we are watching in the weeks ahead as global energy markets adjust to shifting economic conditions. This week's data will likely influence the Fed Reserve's approach to monetary policy. Robust labor market figures and rising input costs in the services sector point to ongoing inflationary pressures, suggesting the Fed may remain vigilant about rate hikes. However, weaker private payroll growth and softening S&P PMI data could provide arguments for a more cautious stance. For the Eurozone, stable inflation at 2.4% keeps the European Central Bank on track to manage policy without immediate intervention. However, economic growth dynamics across member states will remain a focal point as policymakers balance inflation control with growth objectives. US-China trade tensions resurface. President-elect Donald Trump signaled a potential reintroduction of tariffs on Chinese imports, citing the need to protect American industries from unfair competition. While specific details of these tariffs remain under discussion, this announcement has already raised concerns among global economists and businesses. Tariffs during Trump's previous administration targeted over $500 billion in Chinese goods and had widespread ramifications, including disruptions in global supply chains and increased costs for consumers and companies alike. If implemented, these tariffs could lead to higher prices for everyday goods such as electronics and clothing. Businesses relying on Chinese imports might face higher production costs, which could then be passed down to consumers. This move also risks reigniting trade tensions between the world's two largest economies, potentially dampening global economic recovery. In Europe, the aerospace sector is preparing for potential US tariffs, particularly targeting Airbus. The CEO of Airbus expressed concerns about the impact of such tariffs, especially as the industry recovers from pandemic-induced challenges. These tariffs could lead to higher production costs, further complicating supply chain issues and increasing ticket prices for travelers. These tariffs could lead to higher production costs, further complicating supply chain issues and increasing ticket prices for travelers. The possibility of US tariffs has raised fears of a trade conflict that could strain transatlantic relations. Europe's response to these challenges will be critical in maintaining its economic resilience and competitive edge in an aerospace sector. Meta, the parent company of Facebook, announced significant change to its content moderation strategy in the United States, transitioning to a crowdsourced model. This move is seen as an alignment with the incoming Trump administration's push for less regulation on online speech. However, this shift contrasts sharply with Europe's Digital Services Act, the DSA, which imposes stringent rules on content moderation and misinformation. The divergence between the US and European approaches could lead to operational challenges for tech companies like Meta, which operate in both regions. It also raises broader questions about the future of online speech and the balance between freedom of expression and digital safety. Iran conducted large-scale military drills near critical nuclear sites and in the Persian Gulf. These exercises come amidst anticipation of a more confrontational US foreign policy under President-elect Trump, who has vowed to reinstate the maximum pressure campaign against Iran. The drills are a show of strength as Iran grapples with severe economic challenges due to existing sanctions. Globally, these developments raise concerns about stability in the Middle East, a region critical to oil supply. Disruptions could lead to price spikes impacting global energy markets. Yields on US Treasury bonds climbed sharply this week, with the 30-year bond yield rising to 4.91%. This trend is influencing global financial markets as bond yields in Europe and Asia also saw increases. Rising US bond yields often lead to higher borrowing costs worldwide, affecting government spending and corporate investments. This development reflects heightened concerns over US fiscal policies, particularly as the government continues to issue substantial debt. The ripple effects on global markets highlight the interconnectedness of financial systems and the importance of US economic stability. President-elect Donald Trump is reportedly preparing to pull the US out of the Paris Agreement, raising concerns among global leaders about the future of international climate efforts. As the world's second-largest polluter, the US plays a critical role in combating climate change. A withdrawal would deal a significant blow to global climate diplomacy and force other nations to intensify their efforts. The European Union's Climate Commissioner, Wopke Hoekstra, called the potential exit a serious blow and emphasized the need for collaboration to address climate change. The EU is reaching out to the US contacts, including at non-federal levels, to maintain some level of cooperation. While the EU faces pressure to step up its climate leadership, it is sad to miss a February deadline for submitting new climate plans, but promises ambitious targets by November's UN Climate Summit in Brazil. This decision could escalate tensions between the US and the EU, especially as Trump pressures Europe to buy more US oil and gas. The coming months will be critical in determining the trajectory of global climate policy. This week, Los Angeles faced its most destructive wildfires in history, with 5 major blazes consuming over 34,000 acres and destroying nearly 10,000 structures. The death toll has risen to 10, with 180,000 residents evacuated and another 200,000 under warnings. The Palisades fire and Eaton fire have left entire neighborhoods in ruins, turning once palatial homes to ash and forcing evacuations of residents, including Hollywood celebrities. In Pacific region, 5,300 structures were destroyed or damaged, while the Eaton fire claimed up to 5,000 structures. AccuWeather estimates the economic impact at $135 billion to $150 billion. President Biden has declared a major disaster and promised federal funding to cover recovery efforts for the next 180 days. Firefighters, aided by diminished winds and aerial support, are working tirelessly, but containment remains low, with the Palisades fire at 6% and the Eaton fire at 0%. Chef Jose Andres set up food trucks to feed those affected, and actor Jamie Lee Curtis pledged $1 million to relief efforts. Fire crews from 6 US states and Canada have joined the battle, with Canadian Prime Minister Justin pledging support. While Britain and the United States are under investor pressure due to rising debt and persistent inflation, the Eurozone largely remains unaffected. Since September 2024, UK and US 10-year bond yields rose by 100 basis points, attributed to concerns over fiscal policies of Britain's Labour government and Donald Trump's incoming US administration. In contrast, Germany's yields increased by less than half percentage points, reflected by its lower debt servicing burden. Debt-heavy countries like Italy and France also experienced smaller increases due to signs of fiscal responsibility and restrained economic growth within the Eurozone. Ukrainian President Volodymyr Zelensky continues his diplomatic efforts to secure military aid and support from European allies and the incoming US administration. At the same time, outgoing US officials finalized a $500 million military aid. Now let's talk about the upcoming week from January 13th to January 17th. On Tuesday, January 14th, US Producer Price Index is expected to come at 0.3%. The PPI measures the average change in selling prices received by domestic producers. A slight decrease in the monthly growth rate is expected, indicating that producer-level inflation is moderating. This could suggest easing pressures on supply chains and costs, signaling potential relief for consumers and businesses. On Wednesday, January 15th, 2025, UK Consumer Price Index year-over-year for December is expected to be at 2.6% compared to the previous number of 2.0%. The year-over-year increase in CPI reflects rising inflationary pressures in the United Kingdom, with the inflation above the Bank of England's 2% target. This data could prompt further monetary tightening, potentially leading to higher interest rates to curb rising prices. US inflation December. On the same day, US inflation data for December, in particular, core CPI month-over-month is forecasted to be at 0.1%, CPI month-over-month is forecasted to be at 0.3%, and CPI year-over-year is forecasted to be at 2.7%. This data will be closely monitored as a barometer of consumer-level inflation in the US. While monthly inflation is expected to remain steady, the slight year-over-year increase highlights persistent inflationary pressures. Core CPI, which excludes volatile food and energy prices, is expected to decline, signaling stabilization in underlying inflation trends. A further decline in crude oil inventory suggests robust demand, which could influence energy prices. This data will also be key for understanding supply and demand dynamics in the energy markets, particularly amidst geopolitical uncertainties. Thursday, January 16th, UK GDP month-over-month for November is forecasted at negative 0.1% compared to a previous number of 0.1%. The GDP data indicates sluggish economic growth in the United Kingdom. A negative monthly growth rate reflects challenges such as declining industrial output and weak consumer spending. This data could add pressure on policymakers to implement fiscal or monetary measures to stimulate growth. On the same day, US core retail sales month-over-month is forecasted at 0.4% compared to a previous number of 0.2%. The core retail sales, which exclude automobiles, are expected to show modest growth. This upstick indicates resilient consumer spending during the holiday season, suggesting a strong end to the year for the retail sector. US initial jobless claims forecasted at 201,000 compared to the previous number of 211,000. A measure of unemployment, initial jobless claims are expected to decrease, signaling a robust labor market. A lower than expected number would further confirm the resilience of the US economy despite inflationary pressures. The Philadelphia Fed Manufacturing Index for January forecasted at negative 16.4 compared to the previous number of negative 6.4. This index, which measures manufacturing activity in the Philadelphia region, is projected to show a sharp decline. A deeper contraction reflects ongoing challenges in the industrial sector, including high input costs and weakened demand. US retail sales month-over-month for December forecasted at 0.5% compared to the previous number of 0.7%. Overall, retail sales are expected to grow, but at a slower pace compared to the previous month. While this reflects sustained consumer spending, the deceleration highlights potential caution among consumers as inflation and interest rates remain high. On Friday, January 17th, European CPI year-over-year for December months is forecasted at 2.4% compared to the previous number of 2.2%. The Eurozone inflation rate is anticipated to increase slightly, signaling persistent price pressures. This could strengthen the European Central Bank's case for maintaining its current monetary tightening stance, which includes interest rate hikes and reduced bond purchases. This is Sherzodbek from CAU Business School. Thank you for tuning up. See you next time.